Hello, everyone, and welcome to another episode of the What the Finance podcast. And on today's episode, I'm happy to be hosting Nick Maggiulli, creator of Dollars and Data, Chief Operating Officer at Ritholtz Wealth Management, and author of the upcoming book Just Keep Buying: Proven Ways to Save Money and Build Your Wealth, which is actually released next week. I think it is on the 13th.
The 12th, it'll be out.
12th,
yes,
sorry.
On Tuesday. Yeah.
Yeah,
Thanks for having me on, though, Anthony. Appreciate it.
Yeah, no problem. Happy to have you. And I guess my first question really is, what was your influence for writing the book? When did you get the idea where you're like, I have to write a book, I have to try and help people?
So I had been thinking about writing a book for a while, but I didn't know when I had enough material. What would it be about exactly? Those were all the questions. And I think honestly, like COVID was the reason I started writing it. And so obviously I was in New York City, March 2020, the first wave happened, right? Out in like by late April, I was like, oh guys, it's over. We've flattened the curve. It's done. We're going to, I was obviously so wrong. Then the rest of the United States got hit like after Memorial Day. And then I was like, okay, then that curve went down. I was like, okay, guys, now it's really over. I was silly. I just thought it was New York. Okay, got to everyone. Now we're really done, right? And then the December wave hit, which is the biggest one yet at that time. And then I went super pessimistic and I was like, this thing's going to be around forever. We'll be locked up for the rest of our life. It was all this craziness. I was like, I have to take advantage of this. And I said, you know what? I've been writing for 4 years now. I have a bunch of content. I just have to think about a good structure to kind of organize my investment philosophy, organize a lot of those things. And that's what I think is going to be really helpful. So that's basically what I did.
Yeah, definitely. Because you had quite a unique sort of entry into finance, didn't you? From what I know, you sort of started writing the blog, and then from there you actually got into finance. Is that correct?
Yes, I was writing it for about a year and probably 3-4 months before I finally actually had my first job in the financial industry. And then, but yeah, and I was working in consulting. So I was more of a data science background. And that's kind of what allowed me to kind of do some of the things that I do on the blog. But I just always had a passion for, personal finance, investing, kind of just wanted to just do a new take on things. I think I wanted to like analyze things with data and see, oh, is this actually right? I mean, people always say this, but is this true or not? So, yeah.
Yeah, and I think throughout the book, it's really obvious that, a lot of your analysis is data. Like you say, keep buying. And when you sort of look back 30, 40, sometimes 100 years, as if you keep buying at these certain times, you're going to, be better than if you buy and sell. So I think that's quite obvious throughout the book.
Yeah. And that's the whole idea is I try not to put my opinion in what I think. Obviously, there'll be times when I'll say, hey, I have a bias here or there. But for the most part, I try to let the data do the talking. And of course, data is not perfect, right? There's obviously behavioral things. There's other things that matter. And I do address those in the book. But I think data can help us make a lot of decisions and act smarter, live richer every day, basically. So.
Yeah, perfect. And if we say go back before you started the blog, like when did you really start getting into finance, and when did, I guess, you start investing yourself or thinking about it?
Mm-hmm. So I was an economics major in college, and we didn't have a finance major where I went to school. So econ was the closest thing. And I didn't even know I wanted to do finance, but I took like intro to financial economics, I think like my junior, either fall or spring, I think it was junior spring. And I loved the course. I was like, oh my gosh, this is amazing. I love this stuff. So I kept reading on it and stuff. And I, had ideas. I wrote down a notebook in like 2014. I graduated in 2012. So this is like 3 to 4 years after I first encountered a lot of these ideas. But I was like, I don't know what I'd write about, exactly how I'd write it. And then once I got better with doing data skills, I realized, oh, there's like a little niche in the market, right? Like I think I could write on this stuff and do it in a way that, makes a ton of sense. So I think that was kind of the onus for it. Like I just realized I liked it. I had a skill for it as well. I actually did well in that class. So because of those two things together, I was like, oh, this could really work for me.
Yeah, definitely. And obviously the book's title, Just Keep Buying. It's a pretty catchy catchphrase. And I guess you could say it's quite synonymous with maybe the current generation. It's like, yeah, buy the dip, buy the dip, buy the dip. But you sort of analyze it and you say, hang on, it's actually statistically the best way to do it. Maybe you can explain where the catchphrase come from, and maybe explain your analysis of why it's the best way to go about things.
Yeah, so I think the catchphrase came from, there was a Casey Neistat video a long time ago I saw, and it was called like 3 words that got me to 3 million subs. And what he said in the video was like, there was another YouTuber named Roman Atwood who told him like, hey, if you want to succeed on YouTube, you just have to follow these 3 words, and it's just keep uploading, right? And so he's talking about his whole journey and how he, Casey Neistat, he's as popular now, but he was like one of the biggest YouTubers in the world at one point. And that was his like phrase he used. And I had, by chance, I'd been like thinking about like, I was analyzing the US stock market, writing and stuff. And I saw this and I was like, why don't I just change it to buying? Like it all clicked in my head almost immediately. Like, wow, that's a great idea. Like, I love it. There's like that aggressive, psychological, factors built in, right? You have that motivation built in, right? And then on top of that, like the data supports it, whether you're in the US or a lot of other countries. And of course, there are exceptions to the rule. Like there are some countries where this does not work or didn't work at certain points in time, but most countries, most of the time, it's worked very well. So if you're a diversified investor, you shouldn't have to worry about a lot of those things. So I was kind of onus for that. And then, I kind of followed that up with a lot of data, a lot of analysis over the years. And that's kind of just what's happened ever since.
Yeah, definitely. And I guess how do you start your analysis in terms of data? Do you just get an idea and then you look into it, or is there any sort of another way that you do it? Or
yeah, so I'll just I don't know where ideas come from. This is a great question. I don't think anyone's been able to answer this. Like I'll be at most random things. I'll get a dream about one. I'll be walking, somewhere. I'll be running on my runs, and sometimes in the morning, and I'll get an idea, and it's just they come from nowhere, really. Sometimes I'll see someone else post an idea. I'm like, oh, I could take this and riff on this in this way, right? So I have people inspire me. So it's all over the place how the ideas come, but then you have to explore and see like, does this actually make sense? And then does this fit my priors, what not? And obviously the result has to be at least a little interesting. If it's not, it's really tough to like, people aren't going to want to read something that's like, oh, we already knew that. Or so I try to give takes that are a little bit different. And I try to like really, I don't want to be controversial, but if the data is not 100% in support of something, I will be like, okay, like, or if I'm saying if the data doesn't support like the current intuition, I'll say, okay, let's see how we can talk about this and draw this argument out a little bit. For one of the examples I talk about, which is very popular in the United States, is, max out your 401k. It's basically universal advice at this point. In the book, I talk about why you probably shouldn't max out your 401k. There are still exceptions to this, but I think most people probably shouldn't be doing this. And I have very good reasons why.
yeah, definitely. And I think you mentioned that, because for a lot of people, they're not going to be able to access that for 30, 40, sometimes 50 years. So for them, it's better. The opportunity cost may be better just to, rather than maxing it out, using it for, like you mentioned, potentially buying a house or sort of for other investments where they could get more profits and potentially, if they need to spend it, they can.
Yeah, I think optionality matters a lot and people don't realize that. And people don't know, like, if you had told me like how things would have ended up in my life, I would have definitely not maxed. Like you always get to the employer match. That's not debatable. The data on that is clear, right? 100% free money. Can't, it's kind of hard to give that up. And no matter how bad the tax stuff is or how high the fees are in your 401k. But I think a lot of people don't even know the fees in their 401k. And as a result, they end up like, oh yeah, I just max. And it's like, if the fees are high enough, you're actually making a negative tax alpha on your contributions. Cause you would have, by not putting that money in and just paying your income tax, whatever, and having a brokerage account, the tax alpha on that would have been a lot smaller. So I think that's kind of the takeaway there.
Yeah, and I think a lot of your sort of like suggestions are really against, as you said, the traditional, I guess, advice. Like you mentioned, don't have guilt if you're spending money, and you don't have to have this like set amount that you spend or that you save every month. There's like it can be fluid depending on the money coming in, depending on the expenses. So I find that quite interesting. So I guess where did that come from, and sort of why do you think it goes against a lot of the traditional advice that most people get?
Because traditional advice says, okay, save 20% of your income or whatever, and just do that forever. And that's fine. The problem is our lives aren't, if you have this was probably true in like the 1950s when there was a one income household and, you got paid your wage and you got your raise. It was like very straightforward. Right now with two income households, there's more volatility in income. Today, where there's so many people doing side hustles and things, income is not as, I think, just straightforward and linear as it used to be. And because of that, I think the savings advice needs to change with it. And so I think we have these old savings rules that are just like, save 20% of your income. And the thing for me too is like, personally, I experienced like if I had tried to do a fixed saving rule, I would have been miserable in my life because like there were times I didn't have a lot of money and I couldn't save a lot. There were times when I had more and I could save way more than like a 20%, right? And I would have been blowing money for no reason, right? And so as I've kind of moved around in life, whether I was like living in Boston, I had a much higher savings rate. When I first moved to New York, I had a lower savings rate. And so it's just thinking about that and like realizing like what really matters is like just being fluid and not beating yourself up. I think that's the biggest part I'm trying to get people over is like, stop with the guilt, stop beating yourself up. It's just money. Don't get me wrong. It's important. I obviously write about it. I know it's important, but I know people that do just things that I think are just silly and they beat themselves up mentally over stuff. I'm like, you're probably going to be fine. Like you're literally causing yourself more stress. You're like reducing your life expectancy from all this, just for like over money, right? It's like kind of silly in some ways. So
Yeah, I think they say the most stressed about thing in, I think, the US, you mentioned that, is money. So
Hmm.
people, and you mentioned like some people might go out for dinner and they're stressed that they maybe didn't plan it. But as you say, it's like try to do as much as you can that doesn't affect your mental health.
Yeah, exactly. And so it's like, okay, if you're having money issues, you're like, I can't save. It's really tough for me to do this. Okay, that's fine. And there's nothing wrong with that. But then if you want to change that, you're going to have to find ways to grow your income. That's the thing I focus on. Stop focusing on your spending guilt. And if that's fine, if you're not saving or have even negative savings for a while, but in your meantime, you have to try and find time in your day or on your weekends or something to try and grow your income. And you're like, well, I don't want to do that. Well, then I mean, I'm not saying it, I'm not trying to be like one of these, grind set, you have to be working 24/7, none of that. But like, if that's your situation, like those are the facts. Those are the facts of the matter. You got to find some other way of growing your income. So whether that, and you can do that through your traditional job. If you're like, oh, wow, like I'm working in this role now, but I think I can do this role and I can maybe develop skills to prove that. And then I'll get that raise or whatever. That's fine too. It's in one of the ways to raise your income in the book. I do talk about, climbing the corporate ladder. And I think that's really, a lot of people like look down on that. And I think it's still a very common way that a lot of people grow their income. And I think it's something that we should be talking about and we should champion and not being like, oh, if you're not an entrepreneur or a side hustle, you're a loser. I'm like, I think that's silly. So that's my take on it.
Yeah, and I think there's so many opportunities, especially these days. As you said, there's you can do it online like you've done, and like, write a book, all these other things. But there's also other ways. You said doing it through traditional corporate. I think there's opportunities as well through investing and different ways that you can invest. And yeah, as you said, there's so many different ways of actually trying to increase that income so you can then save more and potentially have a better life.
Yeah, I agree. I completely agree with that. And so that's what I try to tell people to focus on in the book. And the data supports that, right? I think it's, I call it the law of the stomach. You can only cut so much, right? You still have to consume things to live, right? And so,
Yeah.
and as what happens over time, you look at the data, it's pretty clear. Like income goes up, consumption does not go up enough to like match it. Like if your income goes up by 10x, most people's consumption does not go up 10x. It goes up like 3 to 4x, right? So it's like that difference, that's how you save money. That's it. You can just look at the averages like that. That's it right there. And that's how most people save money. And of course you're like, but I know this rich guy who spends all his money, or I know that's like, I know the celebrity that went broke. I know you. I mean, yes, you can probably rattle off 5, 10 celebrities, that went bankrupt. Yeah, guess what? I can. That's your data set. 5 to 10 people. Mine is every other celebrity. Like you have n equals 10. Mine is the rest of the celebrities minus 10. Like you see what I'm saying? Like my data set's much bigger. Like most of those people do not go broke and bankrupt. Most of them stay rich, right? So that's the key takeaway, right? And we don't know anything about their mindset or their habits or any of that. What we do know though is they have high income. So that's why I'm not against mindset. Mindset definitely matters, especially if you need a mindset change to get you into the mood or get you motivated to work harder or find something else to do. That's fine. But at the end of the day, I don't know anything about like The Rock's mindset or Oprah's mindset or whatever. You name any rich celebrity out there. I don't know anything about their mindset. What I do know with certainty is they have a high income, right? And so that's the thing that I think definitely matters because we can measure it and it's true. Now, of course, mindset matters, but it's not measurable in the same way. So I'm like, until you can prove with like randomized controlled trials of like, we force these people to follow this mindset, which is impossible. And then we force these people as the control group just to do whatever. And then we just measure the differences. We can't do that. And until we can, I kind of want to be like, mindset people, like back up a little and like, just realize like, this is not this is not all mindset, which everyone says. And I just can't, like, you can't prove that. It's unprovable, which is why it's such a great tagline because you can't prove it. So I just get a little, peeved by that.
Yeah, and you could say that's like, people find these outliers and they say, oh, that's how everything works. Like you could say, someone who's made all their money off Bitcoin or someone who's lost all their money off Bitcoin. Like they find these outliers and then they sort of attach to that story. But as you say, there's so much data in between of different things that's happening.
Yeah, exactly. I completely agree with that.
Yeah, perfect. So, the book's divided. We've mentioned quite a lot about savings and it's also divided into investing. But I feel like, most finance is about investing and, trying to, where can you get the best returns? But you mentioned how important savings is to sort of achieve these financial goals. So, I guess, why do you think people overlook that? Do you think they're just so focused on trying to increase their money, or what's your opinion on that?
So returns obviously matter, and especially if you can compound them for a very long time, right? The difference between a 10% return and a 20% return in 1 year is not that big unless you have like a very large amount of money. But any 1 year is not going to matter. What really is going to matter if you can do that for 10, 20 years, that's a huge difference, right? Or even 1 or 2% can make a huge difference over like a 20, 30-year time span. The issue I have with just focusing on returns is people focus on returns without any like regard for what they're saving. Like imagine, and I'd made this mistake myself. I was 23 years old. I had spreadsheets. I had all, should I be 5% bond, 10%? I was neurotic. It was crazy. Right. And I was like looking at all this data, and it didn't matter. I had $1,000 to my name. It didn't matter if I got a 10% or 20% return. It would have been nothing. Right. It's like at the same time, a 10% return on $1,000, about $100. I was regularly going out with my friends in San Francisco, and you go to dinner, you go to the bar after, you get your Uber back, right? That's $100 gone just like that. And today it's probably even more, right? So it's like I was spending my entire investment return in one night. Now that's not a warning to not go out with your friends. That's not the point of the story. The point of the story is you shouldn't be focusing so much time and focus on returns when they're not going to matter until you have a lot more money. So I think a lot of people, especially, maybe who don't have as much money, like, I don't know what the right amount is. I don't want to put an amount, but if you have like $1,000 invested, no offense, your returns generally don't matter. And there are exceptions. There are going to be people like, well, Nick, I bought these NFT things for $100 and now they're $100,000. Okay, yeah, the 2021 was the craziest year ever in like investment history, and that was like a once in a lifetime return. If you can keep doing that over the course of your life, you'll be a multi-billionaire, and you can write a book telling me how wrong I am. Until you do that, until you can do that over and over again, do it, because I'll wait to see that happen, because it's not going to keep happening, right? So I think my take there is just like, when you have a lot of money, that's when the investment returns matter. So for those people that do have a lot invested, yes, your returns are mattering. You have to focus on that, right? But for those that, can still save a lot of money and their investments are earning them a lot, just focus on that. Focus on building that base, because once you have that base, then it makes so much of a difference what your returns are.
Yeah, definitely. And I guess you could say it's not about what you've done in the past few years, about that consistency over 10, 20, 30 years. Because I guess we see so many investors who come around, they make a hell of a lot of money in the short term, and they lose it all because they've been taking these crazy high risk investment plays that, at the end of the day, it's going to go against you one day, unfortunately. And, a lot of times it does. So as you said, it's like that consistency and trying to build a strategy that works over the long term.
Yeah, I think 2022 has been like a great response to 2021, because if but in November of 2021, like everything was near its peak, right? Whether that's crypto, tech stock, these, speculative small cap tech stocks, which now became kind of medium cap tech stocks, I guess, right? All these things were happening. And 2022 showed like really the tide went down, and now we see who really knows what they're doing, and who's just like, oh, wow, I just was literally in like one of the craziest, like, micro cap and crypto bull markets ever. And then it all crashed. And now there's a lot of crypto still down 50% from its highs, 60, 70 plus. Right. And so I think this year has been a great answer to that euphoria that we had last year. And so it's good to kind of see that. And I don't mean it's good for people to lose money. I don't mean it like that, but it's just like, it's a sobering wake up call for people who are like, oh my gosh, I had a friend who was like, oh, I 10X my money in 2021. I think I'm going to do like 8X this year, then I'll get out. And I, it's like, for me, when I hear that, I'm like, that just like, of course it could happen, but like, gosh, man, that's kind of scary. Right. And so, and obviously things have come down a lot since. So I don't think that person's gonna be 8Xing their money this year, but it's wild. It's wild times.
Yeah, definitely. And I guess that's the benefit of, as you said, just keep buying the dip, or in terms of like, I guess, because throughout you mainly focus on, rather than individual stock picking, mainly focusing on sort of S&P, like, indexes and all that stuff. So I guess the benefit of that is if you keep buying the dip, then even when it goes down, you're going to get it at a better price and it's going to go up. But if you're using that on these really speculative stocks, they could just go to zero. They could go bankrupt, whereas the index, hopefully that won't go down that way.
If index goes to zero, we have bigger things to worry about than your investment portfolio, right? This is where the guns, canned goods, ammo type thing conversations come in, but we can put that aside for now. But I agree with you. I mean, so the whole thing about just keep buying is like, just buy consistently. Like, yes, when there's a dip, you're going to be buying, because you're going to be buying regardless if there's a dip, right? And that's the whole idea. And so the people that save up cash to buy the dip, I think it's a very, it generally doesn't work. And the only time it works when there's a very large dip. So like you have to like know there's going to be a dip, and then you have to know there's a very large dip, right? And I remember I actually wrote a blog post basically 5 years ago called Just Keep Buying. And it was one of my first blog posts that did really well, and became kind of, parts of that became the intro to the book. And this was early 2017. And there's a lot of people saying like, oh, market's too overvalued. Like, I'm just going to wait until there's a crash, right? Well, guess what? 3 years later, you got your crash, right? In March 2020. Here's the funny part. Even if you'd saved cash from early 2017 and you perfectly timed the bottom, which is obviously impossible. Let's say you perfectly timed it and you knew March 23rd is the bottom, and you bought on that day when the market was down 33%. Even if you had done that, right, you still would have bought at prices 7% higher than what you could have bought in 2017. Now, of course, buying that dip, instead of buying over time would have been amazing. But like, who's going to be able to do that? Like, do you realize how crazy the scenario I'm giving you? I'm like literally saying, the dip's coming, and then how big the dip is, and then exactly when to buy that dip. Like, you don't like, it's not like March 20th, like, oh, should I wait or should I buy? Like, no, exactly. Like, I'm giving you perfect information, and still you would have bought at higher prices. If that doesn't show you how silly this strategy is to like wait for these big dips, like they just don't happen that often. And so most people end up losing money. And you might get it right here. And here's my counter to this. Like, you might buy this. Let's say you're just like, I'm going to be in cash, and then a dip occurs and you buy, you're like, wow, I'm a genius, right? You might get it right here, but you're going to mess it up in the future. And that's where you're going to lose your money. So you're going to make some money here, but I promise you're going to keep following the strategy. And over the long run is going to underperform. And that's how it's not death by like a quick fall. It's like death by 1,000 paper cuts. You slowly just lose money from inflation, right? Sitting in cash while the stock market keeps going up, basically. And so it's that difference that's going to slowly just fade your money away. And that's the issue that you have to worry about. So.
Yeah. And I found that. And I guess the issue then is like, you're probably going to sell a lot before the actual high. So that's the thing. You might buy at the very low, but then you might, slowly sell and take your profit. But then, we saw in the 2010s, a lot of these companies went a lot higher than I think a lot of people thought. You can link to Apple, Amazon, all these tech companies. They went a hell of a lot higher than maybe people thought, and, they would go in 2010.
Yeah, exactly. And I did an analysis, not in the book, but I did an analysis on just buy the dip, where you follow that exact strategy. You save cash. As soon as you hit an all-time high, you save cash until there's a dip of a sufficient size, whatever size it is. You say 20%. So as soon as the market's 20% below its high, you buy, like anytime. But remember the price could keep going up, and then 20% dip, that could be much higher than when you originally bought. And usually it is. That's why this strategy underperforms. So I followed that strategy through, and it's just a terrible way to invest generally. So don't recommend it. Plus it's nerve-wracking. It's like, you have to think about, like, that's the problem too. You have to spend time and attention focusing on that. I don't have to do that. My time and attention is on creating content, on doing stuff to add value to people, which makes me income, which then I can use to invest, right? So it's like, I'm going to make more in the long run by following that strategy and adding value for people, and not spending any time on my investments because I'm just buying every single month. And you should be like, it's like, or do you think that you're like a great investor? Like, that's the question. If you're doing this buy the dip stuff, do you think you're the greatest market timer in history? If you are, then good luck doing that, but you're probably not. So you should probably find like, what are your actual skills and focus on those. If your actual skills are like working at a tech company, you should be doing that, or being a website designer or photographer or whatever, name something, being a chef or something. You should be spending your time on that and getting really good at that and adding value there, because you'll make more income that way than you're going to make through this like buy the dip strategy, right? So that's my take there.
Yeah, definitely. And I guess a lot of the times you're looking more, you're focusing on yourself rather than looking at exogenous impacts like, macroeconomics, all that stuff. Do you think that's, people should focus on that, or no? As I guess basically what you've been saying is that, it's just too much stress for a lot of people. They just focus on their income and then just keep buying.
Yeah.
Rather than focus on macroeconomics.
Yeah. I think macro is really distracting to even spend time on it. And like, every time I run a macro thing, I've never found anything useful. Even today, like I put out a post today called, today's April 5th, the day we're recording this. I put out a post today called like the yield curve and just inverted, now what, right? Yeah. And the data is clear. After yield curve inversion, stock returns are not great. Like, I cannot lie. Like, the stock returns don't look great going forward. In the next couple of years, don't look great, right? So yield curve inversions are generally bad for stocks. However, what can you do about it? You're like, oh, you know what? I'll just buy bonds, right? Well, guess what? Bond returns are even worse during those periods. Like, if you follow the bonds after this, they're even worse, right? And so it's like, you don't have options. You just have to eat. Like, this is like, oh, we got unlucky. Oops. Like, we just have to deal with it. And that's what I think a lot of times macro is like, there's very few timing things. And if those things do exist, are they going to persist over time, or will traders figure this out and trade on it? Like, there's just too many smart people analyzing the data. They would have figured this out already, and they're going to trade on it before we can. So my take is like, don't just ignore macro, basically. Of course, like, you can't ignore like local macro. For example, let's say you're a Russian citizen and it's like, February 2020, all the stuff happens, the war breaks out. Now, like, there's all these sanctions. You do have to care about macro because it's literally affecting your life on a day-to-day. Like, you might not be able to get money, all that. Then macro is everything, right? But for most people, like, these little, oh, there's a yield curve inversion, oh, inflation's high. Like, unless it's like a, tail event that's literally going to change like history for a country, like in a very big way, I say you generally can ignore it. So, until it's like possibly world ending or nation ending, then I would say don't worry about it too much.
Yeah.
And then, as you said before, even if it is like, is your investment portfolio really your biggest worry, right? Which we get back into that other conversation. Yeah.
Yeah. And you can see, unfortunately, in Ukraine, like for a lot of those people, it's just survival, isn't it? It's just like trying to look after their family rather than worrying about this money.
Yeah, exactly. And so it's like, okay, well, I can move to cash, and then okay, then do that. If you think we're in one of those scenarios now, then do that. I just don't recommend it. It's generally not true. So yeah.
Was there, when you looked at sort of the yield curve, obviously inverting, was there any asset that performed? I'm not sure if you could see that, any that performed better than others, or
I didn't consider every possible asset out there. So maybe gold does or something. I mean, maybe there's some assets, but I'm just looking at stocks, bonds, which is the standard, people look at. I don't necessarily have enough data to grab all. If I had the data, I could run this and just figure this out. But, I'm just saying that that's the traditional thing when something bad happens, is move to safer assets like bonds and cash. But I'm saying, like, that doesn't look like that's the safety is not the thing here. It's like, it's not that you're going to have a negative return after a yield curve inversion. It's just the return is going to be lower than it is normally. So it's just like, oh, things aren't great, but we're still getting a return. It's just not as nice, right? That's basically what happens usually in the median case. So
yeah. I guess the issue then is if you sell and go into another asset, there could be capital gains, it could be taxes, it could be all these other things that would actually, further reduce your potential gains.
Yeah, as well. That's another issue as well. Yeah, which I didn't really get into, but that's of course true.
Yeah, definitely. And do you think, the US, I think there's this thing about a new law and, probably won't affect many people, but I think over 100 million, it's a 20% tax every year, even on, gains that haven't been realized. I'm not sure if you know anything much about that, or
I don't know much about it, but I understand like the general concept of taxing unrealized gains. I think it just, I don't love the idea. I think there are cases to be made for like billionaires that have like, okay, you've had like this private, you have this private stock investment, and your private ownership in a company. You've had it for your whole life, and now you're worth $100 billion on paper, right? You've never liquidated any of it, right? And it's like, that's money that like is not going to get taxed till much later. And then the super rich can do stuff like borrow against those assets, so they never have to sell, so they never have to pay tax, right? So it's like there are cases to be made but they're edge cases and they're small. And yes, it is weird, like, oh, you're only going to tax 400 people, like, in just like all of society and tax 400 people. And I don't feel that bad, because like obviously, like, of course these people worked hard, but did they work 40 50,000 times harder than than like the billionaire or some other person, right? Like, I don't think so. So my take is like, I don't really feel so bad for those people if they had to give up 1%, had a 1% unrealized gain tax like a wealth tax every year. Some people say, oh, that's crazy, you can't do that. But I'm just like, what are we talking about? Stop defending billionaires. 1% of like, and then we have to like, what do they have to sell? No, they just hand the assets over to the government. Let the government figure out what to do with it, right? And let that be on the government, right? So just hand the shares over, right? Like, it's so simple. It's like almost like a wealth management fee or something. It's like, it's not that outrageous. Like 1% is not that outrageous of a fee. And I just think like, I know that's a hot take. I'll say that's a hot take, yeah. But I just think like, in the grand scheme of things, it's not that big a deal. Like, I think these people can easily afford it. And, I know I get thrown under the bus for saying that, but like, how else are we going to fix wealth inequality? Otherwise, we don't. It's just going to get worse. Like, I think we're going to have a trillionaire. We're going to have a trillionaire within the next probably 2 decades. We'll have a trillionaire, and it's going to be like, I'm worried more about the pitchforks and what that does to society than I am like, think about the trade-offs, right? Like, I'm more worried about the pitchforks and society collapsing than I am about upsetting a couple hundred billionaires. And yes, that's not fair, but it's 1%. Just pay your tax and stop. And then we don't go beyond that or something, So that's kind of the idea, but it's a little controversial, I'll admit, but that's my take on it.
Yeah, I agree. I think 1% would be good. I guess my concern is if it goes to 20%, then like how could that impact the markets? Because as you said, if the government takes the stock, then what do they do with it? Are they going to sell it? Could that, drastically impact the markets? I guess, yeah.
They don't have to sell it. I mean, think of what does the Fed do? The Fed buys stuff and holds it on their balance sheet. I mean, why don't they do this? Think about this. Why don't they hold those assets, put that in a sovereign wealth fund, and then whatever dividends get paid out of that gets paid back to citizens as like a freedom dividend or something, right? Like a dividend that gets paid to citizens. They don't have to sell anything, right? They just get the income from it. So that doesn't distort market prices. They're almost like a passive index owner, right? In a way. So I think there's a lot of ways you can do this, like in a smart way that doesn't distort markets and things like that. But yeah, I don't think like a 20%. I don't want to cap tax unrealized gains. And obviously wealth tax would do that, but it needs to be a very high limit. And I don't want it coming down to like below billionaires. I don't want that at all, because like, I think now why some people will fight against it, because they'll say, hey, it starts there and then it comes down, just like the income tax started. I know the income tax started on people like over $500,000 in income, after just for inflation, and then it came down to everyone else. So the question is like, how long until the wealth tax hit everyone else? And that's a fair argument. So that's probably the biggest pushback, and I agree with that. That can get scary, but that's the only way to tax unrealized gains. And what happens if you get taxed on it, you turn it over, and then like the price of that thing drops, now you're no longer a billionaire? Well, then you have capital losses and you can write that off the rest of your life. So like, there's probably ways you can have a capital loss off of that. If you donate, if you give up some percentage and then now your assets aren't even worth that much anymore, you can have a capital loss to write off. So something like that.
That'd be pretty interesting. I guess you could say like, because obviously Norway is quite a good example of a sovereign wealth fund that's, really made supported the government for tens of decades. But I guess from there, you could almost like have a sovereign wealth fund, use the 4% rule, which you mentioned in the book as well, where, for most of the last 30 years, stock markets on average gone up more than 4%. It's gone up 8-9%. So then from there, you could spend 4% of it and continue to go up. And I guess it's sort of similar to, some of these massive university or colleges, their endowments and how they do it. So I guess that's quite an interesting way to do it, potentially.
Yeah. I mean, I still think there needs to be a lot of debate on this. Like I'm not pushing this like this has to happen. Of course not. It's just an idea. And I know it's controversial and I understand some of the counterpoints, but I just want people to discuss it more and think about it more. And I think it could help some people. So.
Yeah, definitely. That's vital. And I guess, we've mentioned sort of psychology and how it can be very hard to obviously buy at the bottom, sell at the top, all these different things. But do you have any other suggestions on how people can, I guess, consider, not control, but like, maybe not get freaked out if it's like there's massive volatility in the markets? Or do you think it's just having a plan beforehand and knowing what you're going to do? Or how can people sort of prevent themselves from just reacting in the wrong ways when there's lots of pressure?
I think there's two things I think you have to do. First is you have to like not identify with your investments. And so by becoming a passive investor, owning index funds, owning things that are like broad market based, not individual stocks, by doing broad market, you kind of feel like, oh, if the market goes down, I didn't choose this. This is just the market. But if you put all your money into Tesla or into Peloton or into pick any tech stock or any stock, doesn't really matter, and it goes down, but the market doesn't, now you feel like an idiot because you deviated from the standard default path. And by doing that, now your identity is hooked up with it. Now you're going to react because your identity is hooked up. So when the market drops, I don't like, oh my gosh, I don't freak out or panic because I didn't pick it. It's just like, it's something outside of my control, really. And it really is outside of your control. So I think that's the first thing that helps. It's just like delink from that, like delink your identity from your investments. The other thing too is realize there is going to be volatility. There's going to be another 50% crash in the stock market. There's probably gonna be a 60 or 70%. I'm betting in my lifetime, I see a 60 to 70% decline in the S&P 500 at some point between now and the end of my lifetime, right? Pretty confident of that. I will see that. And that seems scary. Like how could it drop 70%? Well, I don't know. Something's going to happen that's going to cause this, right? I'm expecting to see that. If I never do, that's great. And so just expect volatility, expect that type of stuff to happen and just accept that we're probably going to have a bad decade. There's going to be another 10-year period in the US history, maybe 15-year period where after inflation and dividends, you actually didn't make money in the US stock market. That's crazy to say and scary to say, but that will probably happen. And when it happens, obviously it's not going to be great, but this is why we diversify. This is why we own real estate. This is why we own, international stocks. This is why we own, et cetera. You keep adding different asset classes, right? Because I don't think it's prudent for a US investor to have their entire equity risk in just US stocks. Now, of course, there are people that do that and they've done very well over this last decade, but look at the decade before. 2009 was arguably the worst decade in U.S. history for stocks, right? That and obviously Great Depression was more painful, but in terms of the actual like decade return, it was worse. So I say like look at that, and that's kind of what's going to tell you, why you should be diversified and why you shouldn't worry about volatility.
Yeah, and I think you said there compared to the US compared to I guess emerging markets, is 70%. Emerging markets went up 70% more than the US over that period. So.
Yeah, but this last decade, the opposite happened, right? Basically, right? And so I'm not saying it's cyclical. It's that means that 2020 is the year or the decade for emerging markets. No, I mean, I don't think there's any sort of like, there has to be that, emerging markets have to outperform US now. No, not necessarily, but I think there will be periods in the future where emerging markets does outperform US and there'll be periods where it doesn't. And so just waiting to figure out how that plays out is the key.
Yeah, that's just statistical analysis, isn't it? As you said, it's happened before in the past. It's probably more likely going to happen in the future. I guess you could say that we've seen almost like, Japan's almost been leading the way in terms of, I guess, what central banks do, how they try to support the economy. They're the first ones to sort of do QE, and then obviously negative interest rates and all these other things. Are you concerned that, I guess, the US could become like, similar to Japan, where I guess, we get something in like the 90s where, or in the, I think it was 1987, where they hit their peak and they didn't come back to it until only recently, I think. So I don't know if that's something that you're concerned about, or, as you said, you just focus on what you can control.
Yeah, so I don't try to think too much about macro. I'm not even the expert there. If you want to talk monetary stuff, I'd say like go talk to Colin Roche. He's going to be the person that knows a lot about this. So like at least with like monetary systems and banks and money, I just defer to the other experts. I try to stay in my lane. So I don't know who the wealth tax expert is, but if I did, I would like go talk to them as the person. But yeah, so in this case, yeah, I would just say I don't have a great answer for that. So
yeah, sorry, I'm sort of going on all these.
No, you can throw it in the pot. I don't care. I want people to know. Like when I don't know something, I just like I don't know the answer to that. It's a great question though.
Yeah, definitely. And I guess sort of one of your last chapters is saying that you'll never feel like you're rich, and you do like a good example of why no matter how much you invest and how much money you make, you're always going to want more. I'm not sure if you can explain that. And I guess how can someone not focus on trying to feel rich? What do you think?
Yeah, so I think I'll explain the first point, which is I was reading this interview by Lloyd Blankfein, who's the ex-CEO of Goldman Sachs. He's a billionaire, and in the interview, he says, I'm not rich, I'm well-to-do. And he says he's a billionaire. Of course he's rich. Like I don't think anyone would not say he's rich, right? But he doesn't think he's rich because his friends, his good friends, Jeff Bezos, David Geffen, etc., they're all like worth 10x him or 100x what he's worth, right? So relative to his social circle, he's not one of the richest people, right? And so he doesn't feel like rich. He can't go buy a $600 million super yacht like these other people can. So I think because of that, like you can understand his psychology, like, oh, well, he doesn't feel rich. But you and I would look at that and say, oh, that's ridiculous. And I say, okay, well, let's play a little thought experiment out then. Okay. To be in the top 10% of wealth in the world, not the US, in the world, you need about, it's like $93,000. Let's just say 100,000 to make it easy. So if you have over $100,000 in net worth, you're in the top 10% of the world. Now, I would consider someone in the top 10% to be rich. I mean, that's just, the top 10%, you're in an upper echelon of society, right? Of any distribution, right? As some sort of distribution. So like you're in the top 10%, I would say you're rich, right? Now you're going to argue, but Nick, you can't compare me to people in the developing world. You can't compare me to some farmer in some third world country. That's not fair, right? Well, guess what Lloyd Blankfein's going to say when I say you're in the top 0.01% of the world? He's going to say, well, you can't compare me to those normal people, right? He's going to make the same argument about you and me that we're going to make about, people in the developing world. And so obviously his argument is more outlandish than ours is, but they're the same argument. They're fundamentally the same argument. The question is where's the, we're cutting hairs here. Like, where's the line? Like, is it nationally, globally, locally? Like, how do you define rich, right? Like, I could say, so that's why I say that I think the solution to this is to say like, okay, look at things on a more absolute scale. Don't look the more local you get, the less rich you'll feel. Like, for example, I live in Manhattan, right? I would say relative to Manhattan, I am not rich, but relative to the world, I am rich. And so I identify as a rich person, even though I may not be rich in my local environment. Like on a global scale, I'm rich. And I don't mean that as like I'm bragging or anything like that. I think it's just a way for me to kind of stay grounded and realize like, hey, if I don't think like this, I'm going to continually chase money to a point where I end up sacrificing a lot of other areas of my life, which I don't want to do. And I think it's about figuring out your enough point, wherever that is where you're like, okay, hey, like I'm doing well, I can live the life I want to live, and I don't have to worry about money in that sense. And I think getting to that point should be everyone's goal, not like, oh my gosh, I need to have more and more just so I can keep up with these other people. Like, it doesn't bother me if I have friends that have 10x my wealth or something like that, because I'll just hang out with them on their yacht or whatever. You know what I'm saying? Like, it's not like if you're friends with someone, you're friends with them because of whatever. And like, yes, like that is what it is. So that's my take on it. Like, how do you get over that? Just like think about yourself in a more absolute picture and stop being so local. Because if you look locally, it can be tougher. And you may be rich in your local environment, great, so, but if not, like that's just kind of keep some perspective there.
Yeah. And I think that's sort of the main thing that I really got out of the book was find that balance between financial security and happiness, and you don't want to go one way or the other where, you sacrifice financial security for happiness, or you sacrifice, happiness for financial security. You want to find that balance where you have both of them, basically.
Yes, exactly. I agree.
Perfect. So, Nick, thanks again for doing the podcast. Really appreciate it. And I guess sort of one last question. What is one message you'd like viewers to take away from our interview and I guess the book as well?
Yeah, well, hope you guys enjoy it. If you check it out, you guys can find me at dollarsandData.com. I'm also on Twitter, so you can find me at Twitter at dollarsandData, and I will, please DM me if you have any questions or just not even related to the book. On my blog posts, I try to answer every single DM unless it's like a little deranged. So if you're deranged, don't. No, I'm just kidding with you. Yeah, just send me whatever, and I'm happy to answer DMs or anything like that. So if I could just give like what's my investment philosophy in like one line, it's like the continual purchase of a diverse set of income producing assets. I believe that is the way to wealth and a lot of happiness. So continual purchase of a diverse set of income producing assets. So
perfect. Some would say just keep buying.
Yes, that's it. That's it.
As you say.
That's it.
I'm getting it. Awesome. Nick, thanks again. As you said, you mentioned all those ways that people can get in contact with you or find your work. So I'll put that all in the description. But yeah, thanks again for your time.
Yeah, thanks. Appreciate it.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.